Alrighty, folks, it is July 20th. We just got existing home sales and they are still down at 4.16 annualized basis. But what we're going to do here is talk about new homes. If you've been following my channel for any length of time, you know that I was looking for a new home to buy. I was hoping for existing, but we ended up buying new construction. And the one and only Lance Lambert just had some conversations with the CEO of DR Horton. So let's talk about builders and what's going on there. How you doing, Lance?
Yeah, doing great, and really appreciate you having me on. And DR Horton's CEO David, he rarely does media interviews, and I think this is one of the first he's done in a few years, actually. So we got a little bit of some exclusive insights here.
Very, very cool. I'd be very interested. What is he saying? I think, generally speaking, just reading all the earnings reports over the last year, builders got conservative when rates spiked last year. They let go of options on land, so they got tighter. They slowed down as rates went up. They realized they had less competition from existing home sales. In my case, my builder offered me a significant rate buy down, also some closing costs. So really for me, buying a new home on price was roughly equal, but my payment is noticeably cheaper. I don't know what he had to say.
Yeah, so that's how I frame the article. And the headline is actually the CEO of Fortune 500 home builder DR Horton reveals how he cornered the housing market amid a historic affordability squeeze. And I think that's the
Oh,
story is, the builders during the pandemic housing boom, they saw their margins reach the highest levels in history. And they had these big margins, mortgage rates spike. What did they do? Well, they just grab some of their margins and sprinkle it where necessary. And it all varies depending on communities. But what DR Horton CEO told me is that what they did is, and I'll read his exact quote, to address affordability concerns in the market, we introduced increased incentives into the market and adjusted base pricing of our homes where necessary. Our most successful incentive recently has been interest rate buy downs. We are generally offering a point below market on a 30-year fixed mortgage for the life of the loan. You can't beat that relative to what's on the market. And the bigger builders have been more generous than some of the smaller builders, is how this has kind of worked. And keep in mind, DR Horton is the biggest builder also in some of the bigger cities that have been hit harder. Austin, they're the biggest builder in Austin, for one example. And that's probably one of the places where you're getting a bigger a price adjustment. And the builders that I've talked to, how they did a lot of the price adjustments is they actually did it in January. And so they have cohorts that they open communities. And so the Q1 2023 cohort saw a lower price point than a lot of the Q2 2022 ones, because they were able to get, they also reduced material cost for that cohort. Lumber came way down. The Q2 2022, not only was that when prices were booming the most, that was also, they had bought that lumber a year ago at over 1,000 board square feet. So that's one part. And he said in total, across the country, there are 110 markets, prices down about 6%. Although you never really quite know how much of that was the adjustment to the Q1 2023. Some of it's building smaller homes. It's still not that 16% median number that you see from census. Yeah. And if the biggest builder in the country is saying they're seeing 6%, it's not, and they are more willing to cut price and do incentives than smaller builders, the actual number isn't going to be 16.
No. Yeah.
And I think the telltale here will be is if in 6 months that census number comes way up, what that will mean is that the primary reason that it was down 16% is because the higher end homes in the communities were a smaller share of what they were able to move product at the end of last year, because they were more affordable product. So what that means is if now they're able to move the more expensive product this year, that will mean the share of the construction sold leans a little higher and moves that median back up. So that'll.
I think you've nailed it. I think a lot of people miss it. when you see a number like new home builders down 16%, that gets a lot of clicks.
Yeah.
But unless you understand product mix and what part of the market is frozen like an ice cube versus which one is hot, again, that's the problem with median, right? Without context,
Yeah.
builders are building smaller homes, which, Lance, it's a good thing, right? But that's going to take the median price
Well,
down.
yeah, exactly. While we need builders addressing the entry level single family home market, if you aggregate the whole housing market up across all the country, you can kind of have this argument of like, okay, we're not really as underbuilt as maybe some people say for everything, like luxury
Right.
homes, maybe, or parts of like Midwest, right?
Mhm.
But if you look at the part that's underbuilt the most, it's entry level single family homes that made no sense for the builders to build following GFC.
What? Yeah,
They walked away from. They
exactly.
focused on the top of the market.
I don't know if
So
you know this, Lance, but home builders are not charities. They're not charities. They're for-profit institutions.
exactly. And everything that we just talked about, he said that's pretty much his assessment. He agrees on, in terms of like, they had the margin, they spent the margin on affordability adjustments, and oh, by the way, their margin's still higher now than it was pre-pandemic. So yeah, it
That's
came down, but
wild.
still higher,
That's
and they met the market.
wow.
He said, in terms of the underbuilt housing market, he says it's hard to pinpoint exactly how underbuilt the country is, but I firmly believe we are in an extremely undersupplied housing market for both new and existing homes, likely for years due to development and construction capacity constraints in the industry.
Wow.
We talked about build for rent a
Okay.
little bit. And so these are actually things you can't like find in any other earnings report. Some of these thoughts here. He said we're still seeing numerous buyers in terms of institutional buyers interested in purchasing our multifamily rental projects and single family rental communities. We have continued to sell our communities to investors at good pace as we continue to scale those businesses. So they plan to continue to scale up build for rent, which I think it's like 15% of all their
Oh,
construction.
wow.
D.R. Horton is uniquely positioned to be the largest provider of rental communities to the growing number of institutional investors focused on reducing the cost and increasing efficiency of the acquisition and management of their portfolio. So kind of boring there, but he plans to keep going and they want to stay number one in that space, which they've been. He said, as of March 31st, 2023, our rental inventories for both multi and single family, which he's talking about build for rent, were 3.3 billion, or approximately 14% of inventory.
Oh, wow.
We don't have a set target for the future size of our build for rent business. We plan to continue to consolidate share in the rental market, just as we have steadily aggregated share in the for sale side of our business for many years.
Well, so when you look at builders, again, not a lot of people expected builders to crush it this year. Something we talked about on this channel that was very likely, and it has happened. When we look out over the next 12 to 18 months, generally speaking, builders are still in the catbird seat, right? Existing listings aren't there. Higher rates, they have the knobs to, make it more affordable. They're also skewing smaller homes, given the demand. Kind of feels like more of the same for the next 6 to 12 months. Is that fair?
Yeah, I think that makes a lot of sense. And I think a very important thing to keep in mind here is we talk about cycles is the Fed has went up 500 basis points, right? In a very short period of time. We're now getting some of the analysts like Goldman Sachs pretty much thinking higher for longer for rates for a long time. Unemployment doesn't break, yada, yada. You still have recession cause. Nobody knows, I don't think. So there is potentially, a risk just based on history of rate hiking cycles, right? And what we know is from the builders, they were able to make it through this rate shock and still keep above pre-pandemic.
That's wild.
So what that means is if something worse were to manifest, well, they could just go back to pre-pandemic level margins and do more affordability adjustments if needed. So I think that's, if you're measuring the downside risk to the builders there, I think the fact that margins are still above pre-pandemic levels is an important thing to note. One other thing that's interesting though, is the rise in construction loans. And you've been talking about this, especially for the smaller players. And, a few people were talking about it today, the National Home Builders Association, that some of the loans just don't make some of the projects don't make sense right now
Yeah.
because the loans on construction loans are up to 12% in some cases. And,
Yeah.
that's obviously not a great thing for, you know, getting as maximum amount of homes built and supply up as much as possible. And housing bears should be rooting hard against. They should want as much construction as possible.
Yeah, this is
Uh,
something I talked about 6 months ago. I think it was certainly 3 months ago. Was that given the regional banks implosion, that the small and mom and pop kind of private builders, they're going to be out of the market. Rates are going to be up. They're not going to get the loans, and we're just going to have big builders control the market. And you're right, housing bears. You don't want less new homes.
yeah,
That's exactly the opposite of what you want. So
yeah.
it's
What the
pretty scary.
bears should want is as much building as possible,
Yes.
and for the recession to hit with construction volumes as high as possible.
Yeah,
You,
they don't need more demand.
yeah, and what's happening right now is where the builders have had too much, they've had a window to wind it down, especially on
Exactly.
the
They
side.
pulled it back in. Yeah.
Yes. Yeah.
Yeah.
The more I look at it, I think the Bears to have gotten more down on price. I think they kind of actually needed unemployment to break in the second half of last year. That's when the builders were the most vulnerable.
They were most exposed. Yeah. Yep.
There was the max fear on the prices and everything. Yeah, I don't know.
Yeah.
But in closing, I think the 5 points that I've been making a lot this spring, very basic points, but I think everything keeps confirming it. The first point, new home sales going up, builders in a better position. Two, the existing market is constrained. Earlier this year, there was the 4.5 million existing report number. Now we're 4.1. And during that time, there's been no noticeable decline in demand. So that is just a constrained market. If there was more supply, there would be at least 4.5 million. Maybe there wouldn't be 5, but we know there would be 4 or 5 because there was earlier this year.
Correct.
The third thing is the institutional side. Although I just talked about the build for rent where they're still kind of there, but if you take the whole thing, they're also constrained. These cap rates don't make sense.
Correct.
4, prices have firmed up a lot of the spring. The declines in the second half of last year have stopped in a lot of the places. The only market that's consistently down on a metropolitan basis that I'm still seeing, and it's with seasonal adjustment, is Austin. And I've been sharing a lot of data from a lot of sources. Most of these places have firmed up. And then the fifth thing is refi's dead.
Yeah.
I tweeted out the other day that if the housing market were the ocean, the home builders on the single family side would be the coral reefs, a robust, bustling, lots of activity, and the refi market would be like the trenches in the deep blue sea, where there's not much going on, and the deprivation and lack of activity
Yeah.
is strangling out life.
Yeah. Folks, you've got to follow Lance on Twitter. He puts out stuff daily. I have no idea how he does it. And of course, read his articles on Fortune. How would they do that, Lance?
They could find me at News Lambert on Twitter, or Google Lance Lambert Fortune to find
Thanks,
my
buddy.
article.
I appreciate you, man. Have a great week.
Thanks. You have a good one.